Friday, September 15th, 2017. Monaco 64 here. So I want to do an early market update, but more importantly, I want to talk about the Bank of England, the price of gold, in pounds specifically. I've had a few viewers who've asked me, you know, why has the price of gold dropped so much, especially against pounds? So before I go into that, let's have a quick look at the markets. Spot gold this morning is at 13.27, down 2.5. The range has been 13.24, 25 actually, to 13.34. It's quarter to 10 a.m. by the way, London time. Spot silver 17.74, down 4. Range 17.86 to 17.69. The Dow is unchanged, 22,210, Dow future. S&P 500 down 1.5 points at 24.93. Crude oil just above $50, $50.13. The pound, of course, very strong. It was up over 1.5% yesterday, and right now it's up again half a percent at 134.52. I'll come to the pound later to explain why we've jumped. The euro is stronger a little bit, 119.22, up 5 pips. And the dollar is also stronger against the yen, up almost half a percent at 110.71. So, yeah. What happened to the pound yesterday? Well, we had the Bank of England meeting. The decision was as expected. They've kept interest rates at 0.25%, so almost zero. We've had those rates near that zero level for years. And also the vote on the MPC was 7, for no change, and 2 for a hike of interest rates, which was as expected. But then they came out with some comments that they're thinking about maybe raising rates in the next few months. And the reason they did that basically is because, you know, we've had higher than expected inflation measures like CPI at 2.9%. And the Bank of England is covering its bases. But like Money Week has said in an article, it says the Bank of England cries wolf again, but the villagers still come running, you know, and what's his name? John Stepik from Money Week says, the Bank of England is in a bit of a quandary. Governor Mark Carney doesn't really want to reverse post-Brexit interest rate cut to 20.25% because he's not keen to admit that he panicked. But inflation, as we pointed out this morning, just hit 2.9%. Unless Carney is very lucky, it won't be long before he has to write a note to Chancellor Philip Hammond explaining why he's not making any effort to contain it. Well, the thing about this letter, I'm sure the Chancellor won't mind that Mark Carney and the Bank of England have inflation, at 3.5%, because that's the rule. If it goes above 1%, above 2.5%, the governor of the Bank of England has to write a letter justifying that to the Chancellor, or is the equivalent of the Secretary of the Treasury. But I remember a few years back, Mervyn King kept it running way above, the 3.5%, wrote letters, and that's fine. I mean, the government is not going to complain that inflation's high while interest rates are low. That's what the government needs. And why? It's because we've got so much debt. And I want to talk a little bit about the UK debt, because that's a huge problem. And it's a huge problem everywhere else in the West. And you might say, oh, you keep saying that the debt is a problem, but we can live with it. Yes, of course, at the moment we are living with it. And I'll explain to you, to viewers, in a simple way first. Let's say that Mr. Smith, for example, had a $1 million house. He had a $700,000 mortgage, and he had a stock portfolio of $500,000. So, his lenders are fine because he's got the stock portfolio, which he's borrowed, let's say, half of it. So he's got half borrowed, 500,000 portfolio. He's got 70% borrowed, £1 million, $1 million house. But let's say the market start turning and the price of that house starts dropping and the stock market starts dropping. That's when the problem comes, and that's why the central banks have been keeping these bubbles going, stock market, housing bubble, asset bubbles going, because they've had to create so much debt. They've had to put the system and everyone into so much debt to keep their fiat money system going that the only way to keep it going is for asset prices to keep going up so it can cover all the liabilities, all the debts. But once it turns, because we all know that stock markets don't go up forever, there are corrections, there are crashes. Once that goes, people in debt and countries in debt will be in huge trouble. Of course, yeah, the price of gold has come off from around 13.55, I think was the high recent in dollars, and we're now at 13.27. But in pounds, last week we got to 1,035 almost, 1,034. And as I speak here now, we've had a combination of a weaker price of gold in dollars, and we've had the pound rally so strongly. Right now, as I speak, we've gone up to 135, so we're up another 50 pips. So the price of gold now in pounds is 982. Am I happy about it? I don't really care because I look at gold as ounces. You know, the movement in fiat money is more to do with the instability of the fiat money or the Bank of England note, or if you want to call it a pound of nothing. But do you really think, you know, like this guy from Money Week says, do you really think, you know, they can really raise rates continuously, you know, and aggressively in a country that has, according to Money Week, you know, and they did this video in 2013, so 4 years ago, about the UK debt mountain. And I've got some information here, you know, in 2010, the coalition government that was formed was left with 700 billion pounds in national debt from the previous Labour government. And then they've had austerity budgets, tax hikes, cuts. And you'd think that they've been able to cut or keep that debt, you know, down. But no, by 2010, the debt had doubled to 2015, sorry. In 5 years, the debt had doubled to 1.4 trillion. Now we're over 1.7 trillion. So since the Conservatives came to power in 2010, they've added £1 trillion of debt. And there's been no cuts. State spending has gone up. National debt has gone up. Interest payments have gone up. And in 2013, if you add all the UK debt, not only the government debt, but the financial debt, private debt, corporate debt, it was 508% of GDP. That was more than Italy, Portugal, and Spain, and almost two times as much as Greece back in 2013. And the top dogs in terms of total debt are Japan and Ireland. And on this video, Money Week go on to say, if you add in the unfunded liabilities, which are public, you know, government promises to the public sector that they haven't funded, the total amount of debt, or the total amount that the UK owes, is 900% of GDP, and that was in 2013. So all that means that we owe 9 times what the economy is worth. Of course, there's the other side of the balance sheet, which are all the assets that the UK owns, which right now is above all the debts, but which are housing, the housing stock portfolios, foreign investments, pension investments. You know, housing is about 2/3 of the, you know, total assets. But now you can understand why we need, you know, the government and the financial sector wants this bubble to keep going, you know, the asset bubble. Because once the value of our assets overall in the UK start turning down or crash, our debts don't go down, they stay the same. And then our lenders are going to pull the plug. And that's when the, you know, I don't want to say the word, hits the fan. So that's, you know, if you think then that the Bank of England is really going to raise rates, you know, to where it needs to be, like 5-6%, there's no chance in hell they'll do that. Because they do that, it just brings forward the total collapse of the UK financial system. And all they're doing right now is just buying time before asset prices collapse. So they've got no choice. They're between a rock and a hard place. And that's why, you know, I've got no problems with what the price of gold is doing in Bank of England notes, because I know that the UK, not only the UK, the only reason I'm pointing out the UK here is because that's where I am, and a few viewers want to know why. But you can put that, you know, it's the same situation in the US. Why do you think, you know, the Fed hasn't hiked rates more? You know, why do you think Trump keeps saying, oh, stock market is doing really well? They need it to do well. They need asset prices high, because the US has even more debt, not percentage-wise maybe as the UK, but, you know, nominally and gross. You know, the unfunded liabilities, the national debts, personal debt, it's all huge. Even in Japan, why do you think the Bank of Japan is buying ETFs? They've got huge debts. They're the top dog. So there you go. Yeah, sell your gold if you want and put it in the banks in the UK. But you know, I think by holding on to the ounces, you know, the ounce never changes. The ounce of gold 2,000 years ago would still allow you to buy many things. You know, good purchasing power. The ounce of gold today, the same. Maybe not as much as last week, you know, but that's just noise. So if you enjoyed this video, please like, share, and also subscribe to my channel if you haven't yet. You can also follow me on steemit.com and on Twitter. And I'd like to thank everyone for the support and all the new subscribers as well. It's good to see the subscriber number grow. Thank you and take care. Bye.